Mic check, mic check. CTM. What's going on, everyone? I hope you're well and doing great as we get ready for today's live session. Wherever you are in the world, I am so glad that you are here. Good morning, good afternoon, good evening. Truly a global community. If you're new here, welcome. And if you're not, welcome back. We got a really strong session ahead. If you might have saw that preview as we were getting ready here together, gathering, and we got just a thorough session. It's what's required in order to navigate these markets. A lot of people, they do prefer just giving up only targets. It's really good for getting likes. It's really good for getting people to subscribe. I can't go there. I need to be correct. That means I need to consider all views and take in all different data to consult the macro as it unfolds in real time. Of course, we have some tools, unlike no other. We do have CTM 2.0 to keep us on the right side, knowing when to be in the market, when to be out of the market, and on what side is absolutely priceless. By the way, coming up, the rest of my day is going to be spent digging into a lot of the work of the summit team, so I could go ahead and check in with all of them, maybe even next Wednesday, have before our live session a meeting with them to move forward. I wanted to go ahead and look at all of the BTC highly valued candidate templates that we have preferred here, that we have valued, and their performance thus far in 2023. Before they do that, I want to start off with this guy. Where is he? This guy. Kind of running the show today. The big news of the day, of course, we're looking at advanced first quarter GDP coming in 1.1%. So it's coming in lower than expectations, and inflation at the same time is coming in hot. That's got a lot of people thinking stagflation. And you might look at the markets and you're like, well, they're loving it. This is a trend day. We're green across the board. It looks really good. But I mean, one thing's a standout. And we're going to get into the NASDAQ a little bit later. But one thing's a standout for me today, and that's them yields are rising. Why is on soft data, why do we saw the job market come off a little bit as well. Why are we looking at the markets here pumping? By the way, before we even get into that question, we're looking at an 86% probability of next Wednesday's FOMC, May the 3rd, being a 25 basis point rate hike. The Fed is still hiking rates, right? That tightening has a lagging effect. And then here's the thing, though. It's this guy. We have, and I'm sure you're aware, that there was released, right? Jerome Powell had a call with the fake Zelensky, right? And the Fed chair admitted, the U.S. is likely headed towards a recession, or rather he said that the U.S. is as likely headed towards a slowdown as it is towards a recession. Maybe today, the softer than expected GDP numbers is having people think that, you know what? Well, the Fed is going to begin cutting quickly. But we also at the same time did see that inflation is kicking up today, and the Fed is not going to like that. The Fed is going to want to stay in front of that. You have to wonder, or I at least have to wonder, is this real or not? And if you go ahead and you look at Jerome and
because the decrease in inflation is clearly less than we would like. And if it starts to rise, is the Fed ready to raise the rate sharply again?
So this guy's fighting a war, and at the same time, he's calling up the Fed chairman. So how does that work? Is Zelensky like, okay, my sons and daughters here are being sacrificed in this proxy war, fighting for life, fighting for their homeland. But I'm interested in what's going on with the situation in the U.S. as far as let me call the chairman. Hey, who's got Powell's number? and he calls Powell. But what I notice over here is the green screen. I personally have never seen Powell before give an interview or talk with the green screen. Now, he may have, and if any of you have, please let me know. I'm interested to know that. And we saw that the fake Zelensky, it's called the fake Zelensky. We saw that he also called recently Christine Lagarde. And Christine Lagarde, just like Jay Powell, fell for it. Okay? And Christine let the fake Zelensky know in that conversation that indeed, in fact, that Europe, that the ECB had every intention of releasing central bank digital currencies. But don't worry, fake Zelensky, you'll be able to spend like $500 or $700 on anything you like, right? For at least at the beginning. That's the little carrot that like you're not completely cut off. And you have to wonder, and I wonder in this world where you see the rapid advancements of technology about what, can you believe anything that you hear and anything that you see now? It used to be anything that you hear, but now it's anything that you see. And believe you me that these deep fakes are going to get incredibly more advanced going forward. So whether or not this is real or not, I do not know. But what I want to get across to you today is that we need to kind of prepare ourselves for questioning everything that we do see and learning to think for ourselves, to think collectively together as a community and help each other make sure that we are prepared. Now, nothing really was new, was introduced. This supposedly was recorded in January, and Powell at the time, he said that, look, we're likely hiking 2 more times and then we'll see. That's exactly what the market has been pricing in all year long. Nothing new was introduced, right? And the question is, for me, is what about June? Right now, June is only pricing in a 25 chance of another 25 basis point hike. As of right now, this is a live meeting. The biggest takeaway for me is what Jerome is going to do next Wednesday. Is he going to keep the June meeting open for a potential rate hike? And then do we have to watch what the CPI reading is, what the job market looks like over the next 30 days? Or does he say that we are pausing? If we pause the markets today, is this any type of prelude as the market's here watching the fake Zelensky? When we talk about fake Zelensky, it's like, well, it's a hoax because that's not the real Zelensky. Or is it the fake Zelensky because it's a deep fake? Is that instead of the Wall Street Journal leak, you remember the old Fed would, like, if they want to get something out to us peasants, they would leak it through the Wall Street Journal. Is now the new Wall Street Journal leak the fake Zelensky leak? And what they're trying to do through the leak of Christine Lagarde is prepare Europe and the world that they are going to be releasing central bank digital currencies. Are they conditioning people to accept what is going to happen? Same thing here with the Fed. Now, the other main takeaway of this little chat that these two had was that right now the market is pricing in towards the end of the year rate cuts and rapid rate cuts into 2024. The Fed is saying, well, as he told the fake Zelensky, that, well, we're gonna change the conversation to that we're keeping rates extended, elevated for an extended period of time. One of these is right and one of these is wrong. I don't know which it is, but I know that next Wednesday, this is going to become the conversation. And either the market is going to have to reprice itself and understand that, well, inflation is actually still a bit of a problem and likely until something breaks, because if something breaks, the Fed is going to have to catch up to the market. So will the Fed have to be forced to catch up to the market, or is the market going to catch up to the Fed? And that really, truly is the billion-dollar question ahead of us. So markets seem to be keying off of today that the Fed is getting ready to pause rates. That is nothing new. That's what the market is actually pricing in, that we have one more, and that likely is the last one, but that is variable. That could change. And if June is a live meeting, and if June does price in another 25 basis point hike, the markets were wrong. The markets are currently priced wrong. If the Fed just holds these rates elevated for an extended period of time, the market's wrong. The markets right now are priced for perfection. They're priced that there's going to be a soft landing, that there's not going to be a recession, that yes, there could be slower growth. And if there's slower growth, that's okay. And that the Fed is going to, even though they're slow, because of the slower growth, going to come in and cut those rates. Now, I know and you know that inflation is a problem, that Jerome Powell has been very clear and adamant that he needs to make sure that he stays ahead of inflation. They can't get further behind. So it does not seem to me that outside of anything breaking, that the Fed is going to just come in and cut those rates, because once they do, we're going to be looking at, boom, those inflationary pressures rising again. There's one more thing that I wanted to share with you. It's somewhere over here. So let me just look for, this is where it is. It could be painful. We don't know of any painless way for inflation to come down. So is painful that growth slows down a little bit. The Fed, because growth is slowing down, takes the foot off the brakes. Like taking the foot off the brakes is pausing rates. That's like the brakes are on, and then they're just going to take their foot off, or they've been easing them off. We've seen lesser degree of rate hikes. So Jerome's been letting up, and now he's finally going to let go of the pedal. That's, and then is he going to just start easing, or is it actually going to be painful? Was the Silicon Valley Bank failing painful? No, that wasn't painful. The Fed came in and backstopped the banks. We saw, let me just jump over to the balance sheet. We saw, Silicon Valley Bank fail, and Silicon Valley, yeah. And then we see the Fed come in and backstop that. That was not painful at all. Is the Fed trying to hurt banks? Well, I mean, maybe the Fed is trying to actually corral a lot of deposits from these small regional banks to the big banks that they control before they get ready to eventually issue out the CBDCs in the US. Hey, look, Europe's doing it. Why not us? Right? Maybe that's happening. When they talk about painful, what are they talking about? Well, when we talk about the Federal Reserve, these central planners, and since they've been around, since 1913, what has happened? You've seen a massive devaluation of the US dollar. Bullish case for Bitcoin. What else have you seen? Well, you've seen actually the rich get a lot richer. You've seen distribution of money from very intentional, from one set of people, we the people, to another, whoever are the shareholders, the families behind the central bank. Do you think that it's going to be painful for them or for us? Who are they trying to make it painful for? Let's take a look at both sides, though. Let's take a look at both sides. This is Fidelity, head of macro, Jurian Timmer, and he's laying out, listen, if earning estimates are correct, a big if, and that's a big if because usually they come down, the market is doing exactly what it should be doing during this phase of the cycle. It's rallying in anticipation of a recovery. Below, we see the typical progression of bear market bottoms going back a century. So we just don't want to say, look, it looks to me that we are headed towards either, as Powell put it, a slowdown or a recession. And by the way, a lot of people talk about that if we do enter a recession, that it's going to be one of those like in 2020, like quick and brief and no big deal. You never know. I don't know. You never know. Jurian's pointing out to us, if indeed that we have, put in the bottom, markets usually bottom 2 quarters ahead of earning estimates. And what we're seeing right now looks very on par with what we've seen in the past, because the bottom could be in. And outside of a credit event, likely the bottom is in. Bitcoin included. Likely the bottom of Bitcoin is in. Now, we've never seen before. Let me just jump over to here. We've never seen before. Here's the green line. On the bull market breakout, underbelly breakouts, we've never seen the bottom then get taken out. Does that mean that it can't happen? Absolutely not. We know that it can. All right, let's just keep going. So, if the October low was the start of a new bull market, the pattern makes sense. The earnings valley and subsequent recovery matches the magnitude and average cycle and the timing, as well as the PE expansion is on track as well. If the earning consensus is correct, the market is not only justified in its recovery to its current 18.5 times PE multiple, but has further to go. By the way, usually at the time of cycle that the Fed pauses those interest rate hikes, equities recover to new all-time highs. Is that going to happen again this time? A 40% multiple expansion from the 15% low in October would take us to a 21x. So we're saying that we have currently at a current 18.5, we probably have up to, on average, 21 times multiple. Using the consensus earning per share forecast next year, blah, 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 blah. And then we have John, and he said, well, do bull markets normally look like this? And we know that we have a select few companies, for example, Microsoft, holding up the market here, and the breadth is absolutely atrocious right now. The thing about this, though, is it says the lowest since 2005. It wasn't into 2007, 2008 that the crisis happened. 2 years is a long time to be offsides. All right, what about this? I want to share this chart with you. We're looking over here at the inversion of the yield curve, the 3-month and the 10-year treasuries. Why it's important is because in the past, when this inversion closes, when the inversion ceases, that's usually when things get dicey. You could see above the S&P 500. Look at every time we come back above and look at the pain that ensues, right? Look at every time we get above, look at here's above, here's the pain that ensues. And then the next question that comes up is, well, what about when I see that when the inversion curve is no longer inverted, that's usually when equity markets are under pressure. By the way, although in the last tightening cycle, when the Fed paused, we saw equity markets, not Bitcoin, equity markets rally to new all-time highs. During the credit event, they took out the lows. That's a little different than what happened with Bitcoin. Bitcoin last cycle, right, when they went on to pause right here in 2018, it didn't make a new all-time high. And during the credit event, it didn't take out the low. Interesting, right? I think it's interesting. I like all the information possible, put it together. So the question that comes to mind is, someone doesn't think that's interesting. Whatever. That's all good. It's fat. Forget that. Forget the interesting part. It's just truth. It's not subjective. Equity markets took out the low. Bitcoin did not. Equity markets made new all-time highs prior. Bitcoin did not. I get that a lot of people, they are under the impression right now that we are looking at in 2023, Bitcoin making new all-time highs. I like this, actually. Markets right now are priced for a soft landing, no recession, with rates coming by the end of the year, or in other words, for perfection. If you believe that, like it. We have a few likes, 13 likes. Or vote below what you think is going to happen. That we're headed towards a recession, that we're headed towards a slowdown, or we're headed towards an economic crisis. And what I like about that, it's pretty evenly distributed, which makes it a market. Anything could happen. If you go back to 2022, most believe in 2022 that we were headed for a recession and something was going to break. If you remember here at CTM, we were like, actually, we're not close to a recession. The economy is a lot stronger than people believe, which people did not catch up to the beginning of the first quarter, 2023, is when that became really apparent to everyone. We also said that things are not likely to break for a long time. Here we are a year later. And finally, and before it happened, we did talk about, well, now things are probably getting ready to break. And then we saw the first shock. We saw Silicon Valley Bank go down. We're now seeing First National about to go down. And there will be more pain for the banks ahead because all of the systematic issues are not going to go magically away. All of a sudden, you're not going to see commercial real estate like these office buildings magically get. I wonder, did you notice that first it was the banks, JP Morgan, who made it essential that their workers return to the office? I wonder if it was because of them understanding what they have on their books and that they needed the rest of the workforce to go back to their offices as well. I wonder. Either which way, I digress. Let's keep going. And so the next thing that comes to my mind is, well, if when the inversion rectifies and things get bad, could that be front run? Is the time to sell the peak, right? And if you look at the peak over here and I look at the peak over here, I could say, well, no, we melted up over here. Why, does anyone know why we melted up over here? That was because the reverse repo market broke and they needed to go ahead and restart balance sheet expansion. Throughout all of this, over the foreseeable future, for the next 6 to 9 months, for the next year, as we undergo this next phase of the tightening cycle, the next phase is when the Fed moves to a pause. It's the time between the pause and the rate cuts. We all know that historically, when they begin cutting rates, things are getting really bad unless they are expanding the balance sheet. And in this particular case over here, the Fed was expanding the balance sheet. Going forward, regardless of what view you form, watch the balance sheet. Speaking of watching the balance sheet, what's happening with the balance sheet today, right? Well, right now, this was huge expansion. And since then, we've returned to quantitative tightening. Watch what Powell says next Wednesday about the quantitative tightening program. It is my belief that we are going to see further continuation of quantitative tightening, and that will continue until something breaks. So if there was any type of different messaging from the chairman, that would be a game changer. That would be a piece of information that has to change one's views. And if quantitative tightening was stopping and rates were being paused, expect risk to explode to the upside. At least I do. Now, we also have to take into account that you can see down here in blue, this is the Treasury General Account. And you can see that we've had a nice little refill. This was coming off of tax receipts, and this is given more time before the debt ceiling debacle needs to be settled. Right now, it looks like to July, right? June, July, that the U.S. Treasury has enough money here to keep the government going without defaulting. So watch on that. Does that give more time here for risk to continue to rally, especially if, it's a big if Jerome says that we're done raising rates? If he says we're done raising rates, that's like a green light for like risk to rally up until we start seeing the double whammy tightening once that the U.S. Treasury has the need to go ahead and actually issue new issuances to, we should see at that point, rates rising. That could be like a double whammy in conjunction with quantitative tightening. And that is going to be a liquidity grab. And we all know how risk behaves when liquidity is being pulled away. It's not a good thing. This is actually a really good chart. most people follow this over here and then looking at global liquidity. And this is global liquidity bottoming over here. And we saw Bitcoin and markets jumping. But I don't really think it's the best indicator. You could see over here that this is in March 2022 where it peaked. Where did Bitcoin peak? Bitcoin peaked in November. Oh yeah, Bitcoin peaked in November. This is a much better monetary base total over here. You could see it right over here in blue. That actually peaked where Bitcoin peaked, right? You see them peaking together. And then as they begin pulling away liquidity, remember, Bitcoin is a hedge against the debasement of the currency. So when the currency is not being debased, it has the opposite effect. And here you could see in conjunction until that bottomed, you then saw Bitcoin rising. By the way, that's not a one-off event. That happened over here also in the last peak in December 2017. You see monetary base total peaking, Bitcoin peaking, and then they come off together. Now over here, by the time Bitcoin peaked, you see that Bitcoin peaked here in November, and you saw by the time that the monetary global liquidity began pulling back, Bitcoin was off 40%. Do the same thing. The same thing happened back in 2017, and Bitcoin was off 60% from the time that the global liquidity began pulling back. This is the balance sheet. This is global liquidity. So what's happening here? Well, we saw this was Silicon Valley Bank, and we saw that jump up. But what's the next? This is a lagging in so much as that we don't have real-time data. If we had real-time data on this, that would be the cheese bees. The cheese bees. What are cheese bees? I don't know. That would be really, really cool. But I imagine that it's going down. I imagine the next print we see is going to be going down. Where else were we? This is really cool, by the way. This is looking at the S&P 500, the SPY, and it is the price change. And you can see only owning it, the S&P, buying it after up only days compared to buying it on down days. Look at the difference. This is going back all the way here to 1993. I wonder two things. I wonder if this also works on Bitcoin, right? This is historically investors are better off buying the dip than buying momentum. Since 1993, owning the S&P 500 SPY the day after red days generated a total gain of 740% compared to just 10% when buying after a green or a flat day. I also wonder, forget just a red day, I wonder what that would look like if the red day was a 0.5% down. I wonder what it would be like if it was down 1%. And I wonder what it would be down for, I don't know, 2% or 1.5%. It would be really cool to see that data as well. I wonder what that looks like for Bitcoin as well. For Bitcoin holders, and one of the reasons why people do it, first of all, the reason that they do it is they do believe that the overall thesis for Bitcoin is the further debasement of the US dollar, the reserve currency of the world. And, why you can taper a Ponzi, you could only do it for so long. We will see further injections of quantitative easing. We will see further expansions of the balance sheet, and we will see much further debasement of the currency. Now, that's not what's happening at this particular moment. And this cycle is not over. We are coming to the point in time where we are up to the pause in the rate hikes. After the pause comes the rate cuts. And after the pause, when we get towards the rate cuts, that's usually when we see risk under pressure. What that's going to look like this time is going to be heavily dependent on what's going on with the balance sheet. So continue to watch the balance sheet. We're seeing risk rise today. We saw that this was episode 1, episode 2, where Bitcoin had deviated from the U.S. Treasuries with real yields. And each time Bitcoin was wrong. And since then, we've seen them in unison, right? We've seen them, now you see Bitcoin rising and yields were coming off during that period, began Bitcoin rising. What are yields doing today? Yields are up quite substantially. I feel like something's off here. We're seeing equities put in a stellar day, likely because of fake Zelensky, having a lot of people think that the May is the last meeting. Jerome told fake Zelensky back in January that we're looking at two more, and then we're going to be headed towards a pause, and markets rally on that pause. So again, my main takeaway is that is expectations. If we do not see markets rally during the pause, that is going to be an enormous red flag. But today we're seeing yields rise and Bitcoin is rising with it. Something's out of place. We'll find out what it is in the next few days, maybe next week. The dollar, let me jump over the dollar, which is also, ever since we found out that Stanley Druckenmiller has been selling the dollar and looking to sell it for the next 2 years, is looking to bottom. It does look like a potential inverse head and shoulders, but that's all meaningless. We are in a sell impulse. That sell impulse continues until we have a buy impulse. That buy impulse here is labeled very well with this yellow line. We're giving it room. You can see that we are following resistance down over here, right over here. We're continue to be rejected by that trend line resistance. We're giving it room until it crosses and closes above this yellow. That would be a buy impulse. If we take out the bottom here, we could come down for a big waterfall. No question about that. What else? We have a lot to look at, so let's keep going over here. We got, boom. Before I get to that, let me start off with the NASDAQ. Let me just come down over here and come down and start on the 8-hour time frame. So let me give you the deeper perspective. Right, here's the NASDAQ. Here's the bear market trend line. Here's the first repair that took place, right? Second repair above the purple line, right? And we are currently in this formation. Now, this formation today looks very close to what Michelle had pointed out. And that is, it looks like, well, that looks like a bull flag, right? And here at this particular time, I'm going to point out before I start removing things so you can see them easier. This was a bear flag, right? We broke down from the bear flag. The support of the bull flag held. You can see that holding over here, right? The green line over here. The green line and the green line is the bull flag. This is the bear flag. Bear flag broke down. Price held, bounced up, was rejected at first by this resistance of the broken support of the bear flag, and has since taken it out. I could remove the bear flag now. That pattern is now becoming noise. Another thing that happened, right, was that originally, and let me go ahead and clean up the sheet for you really quick so you could see. Originally, we had the sell impulse, and that sell impulse triggered, and that sell impulse, you have to wonder if it's still in play, right? You can see that we're coming up to that resistance. That broken support should now be resistance. And that's also a conjunction of horizontal resistance up there. We'll look for where the buy signal comes. Let me jump back down. Let me talk about this next line over here. That was 13,000. 13,000 just below it, right? Technically, I have it at 12,960. You can see that we've had a close below it. And then yesterday, close above it. That was not a buy signal for us. Let me keep going. Oh, no. Could I get back? There we go. Yesterday, we left off our analysis. And we said that, boom, if we see the support hold of the bull flag, if we see price trading above 13,000, the breakout and the buy for those like day traders is above this buy impulse. That buy impulse has triggered. It negates the sell, buy, and you're coming into an area of resistance. Do you see that? We have the horizontal resistance we just pointed out. We have this area of trend line resistance, and then we have the Michelle's bull flag trend line resistance as well. So in this area, we have a confluence of resistance. Price needs to break out above there for us to be looking at a leg up, that leg taking us towards this resistance above if it has to occur. But we are coming off hot, up 2% today, coming into an area of resistance. Is the symbol M2SL? For what symbol are you looking for? Are you looking for the symbol? Let me just jump back over here. Let's show about the liquidity. And so we're looking at, this is the symbol. You could take a screenshot. A lot of people wonder what symbol we use for two things. This one's a little complicated. So it's too long is all, right? I could put it into the chat. And then this one is the one people can't find at all in TradingView. And let me go ahead and share this one over here with you all so that you could pull up the tips with the real yields. Now you need to invert the chart though. Like I have this chart inverted down over here so you could see the inverse correlation, because you can see it matches up perfectly with Bitcoin. If you go ahead and add this and it's not inverted, you have to go ahead and invert it. It's going to look like this. And then like most people, when I line it up like this, they have trouble seeing the connection because it's an inverse correlation. Yes, I forgot to mention, let's get it in over here. And Meta popping 15%. So we're seeing so far Alphabet, Microsoft, and Meta all crushing it, big tech crushing it. We got Amazon after the bell today. And it looks like we are seeing tech saying, we don't care. We're still in here. We're doing well. And markets are thus far acting appropriately to it. And not only appropriate, we continue looking at, right? Triple bottom, one repair, two repair, consolidation, and a breakout above, right? Back towards the trend into the next area of resistance above. This is the major breakdown. Be prepared. Watch for the breakdown. However, the further we get above the purple line, that's also becomes a big area of support. Let's look at Bitcoin together from a discretionary perspective. And let me just jump in. 177 people here today. Yes, let's do that first. Before we look at Bitcoin, let's go ahead and take a look at a few different things. First of all, the 10-year, it is almost in the middle of the channel, right? We could see this channel that price is currently consolidating in, and we are in the middle. By the way, a breakdown outside of this channel, that likely takes us into this area of support. Now, if Powell is signaling that we are going to be higher for longer, which is correct here, I'm not entirely sure. But all I could say is, I mean, I can't, no prediction. We're just in the middle here, right? And that's a good place to be ahead of the FOMC. What about the S&P 500? We didn't take a peek. And pretty cool looking back after our session yesterday or the day before, when I took the clone line, I put it off the bottom here. That's what price has held, right? Now, that sell impulse is very much still in effect. That's not really taken off. What would go ahead and take that away? Let's look at that on a smaller time frame. And a break above there, that would be the earliest signal that we are negating. So I see the S&P 500 coming into resistance. I see the NASDAQ coming into resistance. And we're looking at a massive up day. Now, the thing is that we're still lower than we were a week ago, lower than we were 10 days ago, right? This is the middle of I said 10 days ago. I don't know where we are. Was it even today's date? Yeah, this is a month ago. So a month ago, 2 weeks ago, and where we are today, and break out above this trifecta of resistance, though, that opens up the door for another leg up, and that leg should be targeting this area, into this area around 13,700. That's a big move up. If you get the breakout, you're looking at another 3% move, potentially in store. We are coming into resistance right now. There, we looked at an oil. I guess it's not the chart for oil. Let me pull one up. Oil on the breakdown outside of our consolidation, right? This gets pulled up. No, not like that. Well, I have it on the other chart. We are now looking at where my mouse is, drawing horizontal resistance at 83.50, we'll call it. But we've broken down over here, and oil over here this is a good sign to me. Why is that a good sign? Because it says to me that there's a good chance, now not this coming month's CPI, which is, it's kind of looking back a little bit. Last month we were looking at higher energy prices, higher gasoline prices. But then after that, we could be seeing a reprieve here, and we want to see inflation continue to come off. The inflation's an absolute killer. So we're rooting for that. Let's look at Bitcoin. Bitcoin over here, yesterday we saw during the live stream, we saw price all the way up here towards the high. A lot of people were feeling a lot of FOMO. Actually, if you jump over and you look at what CTM 2.0 did on the daily time frame, at that point we had a pending buy, kept us out of the market. Also, it had not only an exit here on Ethereum, both of those did not happen. You remember we talked about 6.5 hours was a long time away. And by the time you had the close, Bitcoin was down substantially. So was Ethereum. There was obviously a lot of that FUD yesterday about wallets selling coming from the U.S. government, Mt. Gox coins moving. And then as soon as people realized that that was indeed FUD, what did we see? Bitcoin come off 8%? Is that what happened? Yeah, 8%. It's a big move. And then since the market here is kind of holding, right? So the importance of not letting FUD dictate your behavior is essential. Looking at this from our continual analysis, we are saying that yesterday kept us below the repair. So that was neutral. Remember, we were neutral in this area. A break about and a close above that level over here, that sends us back, regaining that important repair. That would be, from a discretionary trader's standpoint, a buy. Now, it does look like that we'll close to, let me just also at the same time pull up the 8-hour on Bitcoin, and you can see that we have a long entry pending. So CTM 2.0 would actually be in conjunction with what discretionary analysis would be offering, and that is if we close above 29,000, that we are looking for a repair and a buy. Now, that does not guarantee that we are then going up. And I know not only to 32,000, I know at this point in cycle, a lot of people are looking at by roughly June, July, price making new all-time highs. Now, for us, that's way outside of what expectations would be. What do I mean by that is if you look at where we are in the cycle, price has never made a new all-time high before the halving, right? You can see this is the all-time high, and price prior to the halving has never made a new all-time high. That didn't occur here. That didn't occur here. What did happen was in each of those cycles, Bitcoin was able to retrace off of its low, and retrace before the halving to the 0.786 retracement fib. That's right around $50,000. So if that were to happen, the FOMO is going to be through the roof. The up-only crew that through all of 2022 was like, this is a correction, this is a correction, this is the last dip, this is the last dip, this is the last dip, this is the last dip. Oh, now we're going lower. Oh, wait, that was the low. Now we're going up to new all-time. It could happen if we see something like further failures for banks, if we see all of a sudden the Fed need to start cutting rates. That could unleash a tidal wave of liquidity that's being held up in the reverse repo market. That could unleash a tidal wave of liquidity. And where's that liquidity going to go? Right? Cutting rates, do I want to go into dollars? No. Do I want to go into equities? Ugh. Do I want to go into something where I could potentially offer some type of self-custody? Maybe. Are we going to see Bitcoin decouple? It's possible. We could see it. It's possible. But odds are, if we're able to come in and touch this area, that we are going to be entering into either a slowdown and or a recession, right? Let me put January 2024 is where the mouse is. Likely before the halving, which is, into the second quarter 2024, April 18th. Is that the date you guys all told me yesterday? Likely we would be seeing risk under pressure as those rate cuts come in, and likely Bitcoin would not be immune to what's going on in the rest of the market. Now, here's the thing though. Even though we were very early off the bottom, looking at the previous cycle ceiling, right? 17,250. A lot of people were focused on the all-time high price print, 19,600. But really the important level was right where I'm highlighting right now. You can see this is where the market found resistance. I call it 17,250, right? On the all-time index. I'm looking at the Brave New Coin Liquid Index right now. And then you could see, move your eyes over here now. You could see that when we broke out, this is where we flipped into support. It's a big level. Do you see over here where Luna collapsed? Where did we come down into? Oh, that exact same that's not the Luna collapse. That's the 3 arrows Celsius collapse. That came right down into that level again. And then FTX finally caused it to break below. It didn't hold there for long. And then once we were able to break above it, that's when the first repair, the major repair, came into place. Does that mean that we can't roll over? No, not. I kind of think that we're going to roll over. My instinct, my intuition is that actually we're going to roll over. We will be looking at, and indeed, we've bought ourselves more time. What do I mean? What does it mean by we bought ourselves more time? Well, currently, price Y breaking down over here, let's call it 27,500. It then very quickly was negated, right? We had the breakdown, and then we closed back above neutral, right? Close back above, that's a positive event. So while we're above this green line, we're not even it's not even a question that we're going to come in and have a test of this all-important level, 25,000, 25,200. That was a major repair for Bitcoin. If we break the green line, then that becomes in play. Then I'm going to be working on what comes if we lose this level. And if we lose this level, we're coming in likely, or potentially, I should say, because we got other support in these areas. We got other support also from an angle like this. And you're only going to understand what I'm doing if you watch every live stream, right? But we have other areas of support. But if we come in and we test this trend line over here, at that point, we're testing the trend line of the bull market breakout. And if that fails, I want us to be very prepared for what happens below. So we will ahead of time be looking at what that looks like. Here's from a CTM collaborative effort over here. You can see a couple of different things. I want to start off by showing you what we just outlaid, right? What's happened in the past is that we have retraced into that retracement fib before the halving. We retraced into that retracement fib before the halving. Is it possible that we retrace into the retracement fib before the halving? Of course, it's quite possible. It could happen. By the way, that also sets up where we are right now. 55 blocks before the next halving, this is setting up, as we talked about yesterday, that golden accumulation zone. That's where we are right now. We are entering into the next. This is what it looked like last halving. This whole area was a time for accumulation. We are now beginning into that area as well. It does, and if you are dollar cost averaging into Bitcoin, do I believe in the bullish case for Bitcoin? Do I believe in the further debasement overall of the reserve currency of the US dollar? I absolutely do. Do I believe that they could taper a Ponzi? I absolutely do. Do I believe that they will have to go back to massive balance sheet expansion? Without question. What we're trying to do is to time all that in between, because that's where the real wealth is created. You could wait for them to go ahead and just dollar cost average. And even if price fails, if we talked about a breakdown, even if price fails, and even if we see some pretty, I don't want to call out numbers yet. I know what they are, so I don't want to. If we saw some type of event that really put Bitcoin under pressure, at that point in time, if you were dollar cost averaging, even if it took an extended period of time, we talk about everyone's expectations are that we're looking for a mild or a light recession. And even if it turned out to be something that was severe and prolonged over a long enough horizon, and you continue to lower your dollar cost average price of Bitcoin, and you continue to not only lower your dollar cost average, but to continue to dollar cost and gain more Bitcoin over the long run, because the end result is going to mean they're going to need to have further debasement through expansion of the balance sheet. You're probably going to be all right. It's going to work out well, but you could do substantially better. And that's what we want to make sure that we do. Let's look at it like this. This is one angle, and you can see this channel that price is currently running in. I could see the touch here, the touch here, the touch here. This helps if I come on the daily. On the daily, you could see it a little clearer. I could see the touch here, the touch here, the touch here, and the touch here. So Jordan, why do you have this line here then? Well, if you come to the candles, right, you can see the touches here as well. And what's interesting is that those touches are coming off of an exact clone of that channel. So that channel seems pretty good, and you might be looking at this and you might say, well, if we break out that channel to the upside, then we should see Bitcoin looking to run. It's not that easy. Let's go ahead and jump over here and just pull up our CTM collaborative lines. And you can see that this line over here that I'm highlighting first, let me go ahead and make it bright really quick for you. And then I'll come back to where we were. Let me just choose like that, right? And you could see that this trend line over here, this was just taken from this trend line over here. This was the last cycle's bull market breakout. This, by the time price broke out over here in July 2020, we called together on a live stream the breakout of the bull market. And indeed, that was correct. That was the last bit of trend line resistance ahead. Now, there was also, you could say there was also a resistance right around here, right? This was what? Well, Jordan, that's what you called the previous cycle ceiling. You could see there was no resistance up here at the highest price point, 19,600. So when price broke below that, that shouldn't have sent off alarm bells to people, because the resistance was over here. So that was the support. That breaking was the big deal. So there was the horizontal resistance, and there will be horizontal resistance up here around 63,000. But we're not worried about that. We're talking in this little bit of episode about trend line resistance. And I took that trend line and then we entered it over here. The next thing we did is place it over here. And we say, well, the bull market breakout will occur when that trend line is broken. CTM then pointing out, well, Jordan, just move that line a little bit lower, right? And you can see the resistance here, the resistance here. There's a touch there. So that's likely more important. And you can see that's what happened going back to the 2012 cycle. You could see that the highlighted line, even though this was indeed the final breakout, it's lighter, breakout, retest, resumption, right? Breakout, retest, resumption. It was indeed this highlighted line that carried more weight. You could see the touches over here, the touch over here, the touch here. And then when it broke out, that was quicker. That then led to going ahead and finding out where these green lines, you can see the green lines are actually the same exact angle as the pink ones. And the green lines, I'm not going to get into how we went ahead and formed them. It's on the daily time frame. And then every time a new low is made, you bring it down to the last swing high until you get down to here. And this is indeed why this is the breakout of the bull market. Let me just come down one more. Why this is indeed the final breakout of the bull market. This is the earliest breakout of the bull market. And that's the difference between being early and late. So you could view the market from that way, but then you want to make sure, where am I wrong? Just because in this past cycle, once we broke the green line, we never took out the low. Just because in this cycle, once we broke the green line, we never took out the low. Just because this cycle now we broke the green line, it does not mean we don't take out the low. And just as earlier than almost anyone that I know, and I think the earliest, truly, we talked about the zero. I see it on everyone's charts now. But when we put it out here, no one was looking at it. And we looked at ahead of time when fear was rampant in the market, what it looks like on the upside. So we're prepared and we're aware. We have to do the same thing on the downside. All right, so the last thing I wanted to do is just go ahead and take these lines and overlay them onto this chart over here. Because you could look at this and someone who is just learning TA, someone who is, they might think that a breakout outside of this channel, that's it. We're off to the races. That's the last trend line break and the bull market has begun. No, the bull market begun down over here. And to be more technically correct, once we were able to close above and hold the previous cycle ceiling, 17,250. Now, you have people talking about, well, once 35,000 is hit, I'm ready to flip bullish, and that likely the low is in. Okay, but you're 100% off where we flipped. And while you're flipping, we're worried about our downside. What does that downside look like? Let's just show you the resist. Even if you break outside this trend line, you come into immediate resistance. You see that immediate resistance from that pink line? And then we all know that we have further resistance up here, breaking out above here. And let me just go ahead and add it one more time onto this chart. You could see, you know, it'd be really cool. If you're in a rush and you got to go, have a beautiful day. I want to keep going here. I want to keep sharing here and then get into some CTM positioning, as well as look at what's going on with Bitcoin in 2023. And if you want to stay and you haven't already hit the like button, go ahead and hit the like button. I really appreciate that. I've lost some of the feed. I mean, Billy, it might take a while to play out. I'm just taking a breather here so we can keep going. I mean, what happens if after the dump? So we don't know, first of all, we don't know a lot. We don't know when the Fed pauses what risk's reaction is going to be. And assuming it follows past cycles, likely we see a continued big up on risk. However, one thing I have to point out is that last cycle, if you go back to 2018, why the Fed was raising rates and running quantitative tightening, why the Fed was raising rates, risk did not bottom until the Fed paused. This time, that's not what happened. This time, risk has bottomed when the Fed began a lesser degree of rate hikes. So it was on that turn of the degree of rate hikes that in real time we pointed out as being such an important event that you saw risk bottom. Do you understand the difference between tightening cycles, between the previous one and this one? In the previous cycle, risk only bottomed on the last hike. In this cycle, risk bottomed on the change in degree of rate hikes, the actual turn. Now, as they move to a pause, that could extend and continue, and risk could have more of a reason to run. Powell could also say June is very much a live meeting and the markets will have to reprice because rates are going higher than they expected. Yields will be going up. We know the correlation between yields and Bitcoin, as well as through tech and yields. So the problems come when they begin cutting rates, and that's assuming that the balance sheet is not expanding at the time. If we run into a place where we're seeing rates cut and balance sheet being expanded, I think that the balance sheet expansion trumps, and I see that we see risk going up. So watch the balance sheets, watch the Fed funds. If assuming that we see typical behavior, by the time they're cutting rates, risk is really under pressure. Bitcoin likely not immune. If they're not raising, if the balance sheet is not rising, being expanded, likely risk comes under severe pressure. If that happens, likely when that's over, that usually ends with something like systematically breaking, and then the Fed needing to flood the system with the liquidity. It's really what they want anyway. It's the only way to keep the whole charade house of cards going. When that happens, Bitcoin is likely going to moon. That's when like the bull of all bulls really begins running when that happens. And that becomes apparent looking at it from a liquidity situation, looking at it from this situation. Like here you could see the massive influx of balance sheet expansion and liquidity. And you could see Bitcoin, the bull of all bulls, really running at that particular point in time. That's when you're seeing alt season pop up. That's when you're seeing meme coins run. That's when you're seeing meme stocks run. And that's when everyone is an expert. Now, what happens, and again, you can't take anything for granted. Likely that's what happens. But there is such a thing as diminishing returns. And that's likely not on Bitcoin. That's likely not on something that's undergoing massive adoption inside of an S-curve. Likely what you're going to see is whether or not it's this coming cycle, likely not. The next cycle, probably so. Or the one after that, it's going to become apparent that there was no such thing as diminishing returns because we're going to be looking at explosive exponential growth to the upside. As you talk about all this money inside of credit markets, it's going to need to go somewhere, especially if we look at over the next decade, rising inflation. If that's occurring, Bitcoin is not going to see diminishing returns. But what is going to see diminishing returns is going to be the Fed injections. So I talked about in 2020 because everyone was worried about some type of I forget what they called the crisis, but insolvency event. And normally how this happens is X, Y, and Z. And we're like, no. The last crisis was in 2008. The response to that crisis was $850 billion. The next crisis was 12 years later, and the response to that was an initial $4.1 trillion expansion in the balance sheet, and then $1.2 trillion in QE for the next 2 years, diminishing returns from that first $850 billion. The next crisis is going to require a massive amount of more liquidity than the one that we just went through in 2020, and likely it's not going to be 12 years away because what we're seeing is actually diminishing returns, diminishing effects on that expansion of liquidity. All right. So the problem is, and I don't think it happens next cycle. When I'm talking about cycle now, I'm talking about the Fed cycle. Right now in the Fed cycle, we're in the tightening portion. Quantitative tightening is running. Rates are rising. The next change in that cycle is when they go to pause of the Fed funds. The change after that is when they pivot to rate cuts. And then the change after that is when they return to quantitative easing. And the balance sheet is rising. When we get to that particular point in time, when they inject all that liquidity, we have to worry about whether or not it's a dud. Whether or not you see an initial reaction where like all of a sudden you're seeing assets just shoot the moon. We have to watch for a rug pull. You can never get comfortable. All right? Especially in these last grasps of the system, we should see shorter and sharper cycles. That was said before the Fed began what is now the quickest rate hiking cycle on history. That was said before then, right? And that's what we're seeing. And we're looking at quicker quantitative easing. Do you think that we get past 2024 without further quantitative easing? I don't think so. All right. Yes. Yes. That brings us back to, let me go ahead and share this link just in case anyone didn't get it. But this is one that should be shared so you guys could dig in and really absorb and read it. Tech seems to be doing well now since interest rates have peaked, right? Since interest rates have peaked. We did see signs this morning, though. Let me jump over to PCE. We did see signs this morning of I don't see the prices. Oh, well. We did see signs this morning of rising inflation. And I think that personally, next month CPI, as we look towards the 10th of May, that actually, we don't have the forecast or anything like that, you know? That actually we might see that a little stickier than desired. And what I'm looking at oil, I'm looking at energy. And I don't think the month after that, I think June will be looking a little bit better, assuming energy stays down as it's broken down outside of that consolidation pattern that we looked at earlier. But it's all variable, right? Yeah, we continue to see. I mean, so the layoffs in tech, just let me address really quick. Tech was extraordinarily bloated. I think if you look at Mark Zuckerberg and him talking about just needing to get rid of a lot of middle management that was basically just doing nothing, only like collecting a salary. So all of these layoffs for tech, I believe, are entirely healthy. By the way, the further tech advances, the more layoffs there'll be in tech because the more automation or the more machine learning or the more AI is going to be taking care of a lot of those jobs. So at the same time they're doing these layoffs, they're also increasing their buybacks. So, I think the layoffs are actually a positive. Now, as far as the economy is concerned, these people that are being laid off for tech, they usually have nice severance packages for the next 6 months or so. They're collecting a nice salary. They got some nice packages. It's a lagging effect. Will that create? You saw Lyft this morning also laying off 1,200 employees, right? It continues across the board. So the BRICS, how is that going to affect Bitcoin this year? So the way that the BRICS could really affect Bitcoin would be if they made a move towards launching the BRICS currency, and that was backed by gold. And if that were to happen, and if you were to go ahead and gameplay that out, obviously that includes some type of trust factor. You can't trust, you have to verify. eventually, likely, and I have no idea on the timeline, they would need to drop gold and move towards Bitcoin. That there's probably a long time in between, but I think that that would also at the same time kind of be sounding the case for sound money. And I think that would benefit Bitcoin. I think that Bitcoin is doing a good job, as we saw from the Silicon Valley bank collapse, of letting other people know and understand about third party risk. And I think that, at first, suddenly, then gradually, I think Bitcoin is doing a good case on its own. I don't think BRICS really affects Bitcoin at all. Is it possible that you saw money going that would, what happened over the last, let's say, 8 years? You saw money that would normally go into gold go into Bitcoin. Like, whether or not you're talking boomers, Gen X, or millennials, a lot of those that would have been purchasing gold and stacking silver instead were buying Bitcoin. And rightfully so. It's superior money in every way. Do I think that we would see any type of reverse of that? If we were to see at any point in time, like, I'll go ahead and just pull this up. If we were to see this breakout from this cup and handle on gold, you're looking at a monthly chart now. That's a 12-year rise followed by a 12-year consolidation. If we see a breakout of this, and then we're looking at, substantially higher gold prices, over the next, through the rest of the decade, as monetary reset happens, right? Would that affect adversely the price of Bitcoin? I don't think so. I think that it would help it. It's similar to, I think it would help it. I don't want to get into my reason why, because that might not be embraced. So, I'll tell you anyway. It could be something similar to like the whole Bitcoin, the rising tide that lifts all boats. By the time Bitcoin's making new all-time highs, people think that they missed it and therefore invest into these altcoins, hoping to make a lot of money. It could be the same situation with gold, right? People could see gold make a quick move, right? Above 25,000, 3,000. Gold's so expensive. The market cap of gold is, let's say at that time it's like $14 trillion. They could look at the market cap of Bitcoin. They'd be like, it's like $500 billion. They might find Bitcoin to be more attractive, and that might actually help Bitcoin. Well, speaking of Russia, we are seeing a big move into the mining of Bitcoin coming out from Russia. And, we see like the hash wars have begun. We see the U.S. kind of stifling that innovation. I don't know. Yeah, let me move over to that. Let me just jump over. I think we should look at it from a log scale. Gold, Bitcoin. So we have it pulled up on different areas. I mean, if you were interested, Andrew, in doing gold versus Bitcoin, there's no question that what you should be looking at is the way that CTM approaches it, right? Why do I say that? Let me show you. I don't have the crosses pulled up. But tomorrow's session, I'll pull up the crosses so we can look at gold Bitcoin. Because gold Bitcoin CTM 2.0 strategy is going to absolutely, it crushes it. But not sorry, I just lost all of my charts. I lost them all. So, Andrew, the reason I focus on Bitcoin, the reason I focus on Ethereum, the reason I focus on Cardano is because those are the ones with the volume that's there. And putting significant amount of money there, no matter who's on our team, we could all trade it, and it's not going to adversely affect anything. One of us, we have massive solutions on the altcoins, and there are those that are focused in altcoins. And by the way, if you're trading altcoins compared to, Ethereum, which is like the leader, it they drastically outperform. But one person trading them, there's slippage. If we're trading them together collectively, the slippage makes it irrelevant. So I don't focus at all. Personally, I focus my money, my capital on what is consistent, what is proven. And that's the way I like to go. We're done because I don't have the charts pulled up. So what I'm going to do here is end this for today. CTM, I'll go live on the private side in about 2 minutes because I want to cover everything going on inside CTM. So that's what we'll do for today. If you enjoyed being here, make sure you subscribe. Everyone have a beautiful day. God bless you. I'll see you all tomorrow.